Today, I wanted to go over something with you guys. I'm looking at a deal, and I wanted to share with you guys a metric that I also use. Everyone uses it in the multifamily space as it relates to investments, and it's called the below replacement cost. So usually BRC. That's below replacement cost. Below replacement. I'm not going to write it down. You guys are listening to it, but it's important to share this with you guys because that's another metric when we're underwriting multifamily property. So this property is in a plus location. It's an A property. It's in a portfolio that came to market. I'm not going to share what that is because it's on the market still. It is a deal that we're underwriting and is under review for us. But I wanted to share it with you because, man, like I want to show you why and what I'm looking for. So whether you're going to invest with me, you're going to do it by yourself. This is another metric as it relates to underwriting a multifamily deal. This is the game. So on this specific deal, this is 159 units. They're asking roughly what's 350,000 per door, PD per door. So what that works out to be is roughly about $55 million. Dollars. All right. So we'll just keep it simple at that. So they're asked the guidance on this deal is 55 million. That's the guidance. But when we go and we look at the package of the property, and you got to know this, which is why it's important to know your own market. You want to learn what your below replacement cost is. That is what it would cost to rebuild this property if you had to go back in and build this right now. All right. So on this specific deal, the below replacement cost is roughly about 500,000 per door. Why is that important? Because that gap of the money that would be there between the 55, that's about $24 million. That's $24 million. That means that you're buying it for $24 million less than it costs to rebuild because it's a below replacement cost, right? Because they're thinking about 350. The reason why this deal is even out there is because it's in a portfolio, but the owner is a developer and their debt's due. It's what I've been talking about. That is the opportunity. But you don't know it if you're looking at the wrong property. Period. So like on this deal, we're able to look at this deal for 55 million instead of paying 350 a door for it rather than $500,000, which is what this thing was built for. It was built in 2018. So here's why that matters is because at some point this property will be worth $500,000 a door again, right? And at 500,000 a door, 159 units, 159. Hold on, 500,000 times 159. That's 179 million. That's an $80 million asset, right? So let's say 80 million because that's really what it is. So you were able to get a $80 million asset, which is below replacement cost for $55 million. Here's why I know that property gets back to $80 million because right now the average rent in that property, the in place average rent is about 2,600 bucks. It's more than that. It ranges anywhere from 1,800. There's four models, 1,800 all the way up into 4,000 because there's some bigger units in this building. It's perfect. Reason why this matters is because typically, and you guys have heard this, it doesn't always work for multifamily right now because the values are much higher. But the 1% rent rule, the if you can buy a property and the rents are 1% of the price per door that you buy, you're in a good shape. Or you want to look for a property that maybe you're about 60 to 75% of the 1% rule per price per door. So when I looked at that property, I'm like, hey, do I think this is the average in place rent? This isn't the actual rent. There's studios, one bedrooms, two bedrooms, and three bedrooms. So I took the average of the four in place rents and I averaged them out to 2,600 bucks. So on this, do I think at any point, because this is the 1% rule here, do I think that $2,600 could eventually be $3,500 on average, the average unit in there, right? So like we have an average. Absolutely. That's only 900 bucks. I know that I can bump rents over time, $900 as a rent bump over time. Let's say it takes me 5 years to do that, 6 years, 7 years, 10 years, doesn't matter. I at least know that at some point, this property, if I bought it for 300,000 a door and the average in place rents was 2,600, I know at some point my average across the board in place rents, if I hold this thing long enough, not if, but when, will be somewhere around 350, 350, 3,500 bucks a month. So also, I also know this. Will $2,600 average in-place rents eventually get to 5,000? Yes, because there's already units in the building that are renting for roughly about $4,000 a month, a little over 4,000. And there's properties around it that are also renting for 4,000. I know that because there's going to have to, because where this property is, you have a lot of A class, A location assets that are trading right now, not because the owners want to sell, but because their debt matured. These guys bought these properties in 2018, 2019. This was built in 2018 because it's new. But that means that they have to sell right now because their debt is maturing, period. So they don't want to sell these assets, especially not at 350,000 a door when it probably costs them 500,000 to sell. So, but that I know that at some point that the average in-place rents are going to eventually hit to be 5,000 a month in this deal. That makes this deal a screaming deal because it has to get there, right? And I know it's going to get there because builders are eventually going to build somewhere in the area. It's going to be really hard to rebuild downtown over here anymore, but at some point they're going to have to build for higher than 500,000 a door, and it's going to take 3 years, and they got to wait to get the debt, and they got to absorb the properties that are already being built and finished off. It's going to be a while, right? Because rents are going to skyrocket. So the below replacement cost matters in this situation. I'm going to share with you why. Stick with me. Now, I know this is math. It's a little bit more advanced. So, but that below replacement cost matters. Here's why. Because let's say we took 2,600 average in-place rent, $2,600 times 159 units. That's 413 times 12 months because everything's annualized. That's almost $5 million, right? Plus on this deal, because it's a A-class property, it's a great location, it is a newer asset, plus 5% for additional income, right? Brings it up to 5.2 million, minus 5% for vacancies, for nine, minus 40% on the average. I'm using this as a rule of thumb, right? Or on the average for expenses, leaves an NOI of 2.9, basically 3 million, right? So on that 2.9 million, they're looking at somewhere around 350 a door, which is 55 million. So I know they want somewhere around a 5.25 cap rate divided by 55 million equals, which is what I said. That's a 5.4 on the cap rate, almost 5.5. But that is valuable, and here's why. Because we're at 55, we already know we're at 55 million. So at 55 million, 55, boom, divide that by the 159 is the 340. They want 350, but 345 because I just dropped a few numbers. They want a little bit more than it's 55, but it's 350, 350,000 a door. So, like I said, that matters because if you were to just do that and you said, okay, fine, we're getting this thing somewhere around 55 million. That's about 350K a door, right? The below replacement cost is 500,000 a door. So it would take 500,000 a door to build it, 159 units plus 2 to 3 years just to get a permit down there. 2 to 3 years, no cash flow, and you can't get the debt right now because the debt market's not friendly. So no matter what, you're still doing better if this was your purchase price going in the door and you're at a 5 let's say a 5.5% cap rate on this deal. This deal is going to pay money, period. This is an irreplaceable asset. This is an A plus location, A plus asset. Basically it's institutional owned right now. Currently, it's owned by an institution because it's a developer, and actually the developer and the institutions are partners in this deal. The debt is maturing. The debt is maturing on this right now. They have to sell, and it is selling in a portfolio that could be pieced together. This right here is always going to be a screaming deal if you're looking at something like this. And let's say, I mean, I would always look on a deal like this, but let's just say we had to put 40% down. 55 mil. I'm gonna walk you guys through how this deal would look. Riches, and remember, we talked about a $900 rent bump. $900 rent bump on the up. We'll just take that, 900 bucks. What would $900 do? $900 times 159. That's an additional $143,000 in income, just the income. Let's say we only did a rent bump or an increase in revenue. Times 12 months, that's $1.7 million. And we used the same cap rate, 5.5% on the cap rate. We'd create another $31 million right? That's and we're gonna use a 5.5, right? If we were to do this, that's an increase. So we would increase the value. The new increased value of that asset would be 31 million. $31 million is what we would create just by increasing the revenue on increasing the rents by $900. Don't matter on that deal. And worst case scenario, this is how I look at it. This is how I think through stuff. Let's say I had to put down 40%. We'd only be putting down $22 million on that deal. Let's say let's make it worse. 55 million, and let's say we had to put down 45%. We'd have to put down $24 million on that deal. 24 million buys us a $55 million asset that would normally sell for $75 million in a different market. The only reason why is doing this right now is because the debt market's not friendly. The interest rates on commercial is about 5.75 or somewhere around 6%. And it's coming down. I get it, but it's not there yet. And you still got to deal with taxes, insurance, all the other stuff. But this right here makes it make sense because we already know right off the bat what we need to do as a business plan is raise rents by $900 to get $31 million before we even start. And if we were to get it right, we'd be getting at least 5% on our money, right? Period. While we're holding it, while we're waiting, it's in a great location. We probably can go through there if I looked at the rent roll and start right away and just say, hey, we're going to take everybody that's coming up right now and we're going to increase the rent by, let's just say $50. $50. Let's say we get, I don't know, in month one, let's say we get 20 people to do that times 12 months. That's $12,000, 50 bucks times 20 tenants out of the 159 is what it was. Yeah, 159. And we got that 12%. We got that for over 12 months. So that's 144,000 that we would make. The right way. 50 times 20 times, yeah, 12. Yeah, okay, I'm sorry. 12,000, right? Divide that by the 5.5%, we would have already increased the revenue, I'm sorry, the value of that property by 218,000 just by increasing it by 50 bucks. But that's the start. We would go in right away and be like, hey, before we even bought, we would be looking at the rent roll and saying, okay, whose lease is up within the next 60 days, 90 days? And then we would start doing that. We would go through and do a survey. Hey, what would it take to get you to stay? But we will be increasing the rents in these for $50. And we would start testing it. 50, 75, 100, whatever it took, we would do that because what is my target? My target to push my management company is to get here as quickly as we can. And if you really think about it, that's not that much. That's what do we say? The average income, um, let's say divided by or times 5%. That's 130 bucks. 130 divided by 900 divided by $130. We just need to do that 6 times, 7 times. So we would need to raise rents a 5% increase on the base, the 2,600 of the average in place rents. We would just need to do that 6 times, 7 times, and we've hit that $900 mark. But the goal here is to raise this by 900 bucks. So me and my investors profit 31 million, right? So that's already replacing the 24 million that we would have put down. So you see why this game is so good, but you got to know this. And I brought all this up because we're talking about below replacement costs. Because if you can get this for 55 million, you're already stepping into what did I say that was? 75. You're already stepping into. I wrote it down. You need for me to write it again. The $24 million right here. So you're stepping into $24 million of equity the day you close. Because we know it gets to 500,000 a unit again. And then, oh, by the way, we're going to raise the rent on the property and make another $31 million. So we got 31, 30, 24. Hell, that's $55 million just by itself. Equity, below replacement cost equity, as well as the new increased value of the 24. That's not including later when we go back, because the goal on that, on a deal like this one, would be to go to the debt market when the rates drop, and then we would refinance the property, take out our down payment. Let's say we went back in and we took out the 24 million, give all my investors their money back. Now we're in an infinite return situation. And oh, by the way, we're still raising the rents over here and we're still going to double and triple if we're going to do that. Then later we're going to do everything what I talked about before. Take a deal like that, package it up with a bunch of other deals. We have no money in the deal. And then we turn around and we either bring it to market, we turn it into a reading, we bring it to the big market, we turn it into paper and sell it, or we hold these things and we refinance again, take out more money, also a non-taxable event, kick that out to my investors, and then we hold those properties and we continue to grow the portfolio using the assets like these. But that's why below replacement cost is so important, because you need to know, hey, if I bought this property at this price, am I still buying it below what replacement cost would have been? So buying it at 55 million, which is what I said that was 350,000 a door, is still below the replacement cost of what would have been $500,000 to go in and build this thing, and 3 years and wait and no cash flow and manage it. Hell, that's what happened. That's what's happening to the developer now. He's trying to get out of it. So not that it's a bad asset, but it is a distressed asset because the debt is maturing. They got to do something. So when you guys hear someone talk about below replacement costs, that's what they're saying. Below replacement cost means just what it says. You're buying it for less than it costs to build. That's the other metric. So yes, you're buying the NOI, but you also want to buy something cheaper than it will cost you to build one. Because if that's the case, you would build it. Simple supply and demand, guys. So I know that was a little confusing because I did go through a specific property, that 159 units, and why that deal was attractive to me, because I'm like, hey, if you can get this below replacement cost, $24 million worth of equity the day you start, aside from the cash flow, aside from knowing what the upside of this thing is, because if it was built at 500 and we can get an average in-place rent to a 1% rule, because even if somebody were to build right now at 500, they would have to lease those units out to start at 4,500 minimum a month to make that deal make sense. And I don't know if they can do that in today's market, especially not when you got a guy like me looking at that, something existing, and is slowly going to incrementally lease their place up to there. You can't just jump there. And if they did, even better, because now I get the opportunity to skip the line and jump there too. Dude, I love this stuff. I love it. You have to be in the game, though. You have to know this. Now, if you don't know this was confusing to you, you just got to invest with a guy like me, because I'm not a spreadsheet guy. I'm a deal picker, but I know why I'm picking a deal, right? I'm looking at the NOI, below replacement cost, price per door, where the rents are today, where do I think they can go at in the future, what's the location, is it a great location? Is that location going to give me a lift without me doing anything? Especially if I'm looking at newer assets today, can I get good debt? If I don't get good debt, could we raise all the money for it? And it's worth buying it all cash to go and put debt on there later when the debt's friendly. And then we get a huge cash flow bump on the asset because now we brought in the debt and we've recapitalized our investors, gave them their money back, and the majority of it. And we sat and we waited while we continued on the business plan, which is raise the income, raise the value, cash out, and boom, we make a whole bunch of money together. Woo! That's what I want. So anyways, this helps. It does. Any deal. It doesn't matter the size of the deal. You still want to be below replacement cost if you're going to buy something. Period. That is the game. Everybody looks at that. All right. From the biggest, Blackstone, Starwood Capital, BlackRock, Goldman Sachs, JP Morgan, all of those guys. Everybody's looking to get real assets below replacement cost and make sure that they cash flow so they can turn around and sell those assets or trade out of those assets later by doing a recapitalize. And you cannot do that unless you know you're below replacement cost. All right. So if you have questions, let me know. Leave them in the comments. Like this video. Share the video. Don't be a hater and a hider at the same time. If you hate it, give it a thumbs down. I appreciate all of it. But I'm here for you. Let me know if you need anything. Let's go. Boom. Are you an accredited investor with $300,000 or more liquid in the bank? I want you to come and partner with me. Look, if you love real estate, passive income, and positive cash flow, appreciation over long periods of time, and you're willing to be patient, come invest with me. Go to bell-capital.com. This is for accredited investors with $300,000 or more in the bank, ready to go. Come invest with me. Go to bell-capital.com.